we talk about this idea of the inflating away debt, you also always talk about the difference in demographics, right? The younger generation who is very much indebted is going to be okay with inflation, right? They have this big student loan debt plus home debt, and they're just starting to make money. The labor costs are probably going to go up with inflation, hopefully, or enough that they can kind of muddle through it. But it's the generation that has all the savings that are going to end up paying for that negative real yield. And that,
correct.
Who's got more political power is the question.
Yes, correct. And then that issue. So let me go back a little bit on the generational analysis. To me, like, one of the most important charts you can make is the ratio of the S&P 500 to the minimum wage in the US. And to me, that is a generational trade. So that ratio has exploded. So I think in the late 70s, when the baby boomers were, making it into the real world. Can you guys hear me?
Yeah, perfectly.
Okay, yeah. You could buy a share in the S&P 500 with 2 days of work. Today, you need to work for 2 months to get that same share. And the reason why I think of it as a generational trade is think of it as human capital versus financial capital. If we want to take a very narrow and unspiritual perspective of life, would say that the goal of life, at least according to the Samuelson textbook, is to convert your human capital into financial capital, so that at the end of the day, when your human capital is depleted, you no longer work, you need someone to help you, you have the financial capital to hire this human capital to take care of you. Right? So if you think of the market, the young offer their human capital, their labor, which is really cheap and unqualified, so that's where the minimum wage comes in, and then the old offer their financial capital in the form of pension or houses or financial assets, and they buy each other. Well, that ratio between the two has been multiplied by 10. So the relative price of an hour of young people work in the money used by the old people has been divided by 10. To me, this is not a way you're creating so much stress. I mean, that social generational contract is the heart of the social contract. Who gets what, which generation owns the asset, the debt. I mean, all of societies revolves around these questions. And we're going one way for 40 years, and we need to go the other way. Now, the only way that I can think of to do that is through inflation. And with inflation, you effectively inflate the cost of labor, which we are seeing now. You see the highest gain for waiters, hospitality, low-end jobs that are disproportionately made employing young people. So you inflate the wage numerator, and then you deflate the denominator, which is the S&P 500, because rates go up, and then at some point the multiple play in. Instead of having the S&P at close to 5 times sales at one point, you get back to more normal multiple, and then that restores the balance. Of course, it's extremely painful for the owners of financial capital.